ladies and gentlemen. Thank you for joining us for the fourth quarter results press conference. We will open with the opening remarks from our CEO, Mr. Salil Parekh, followed by the Q&A for the media. But before I hand over the mic to Salil, I would like to make few announcements. We have set up the media center in Building 12. So friends from media who would like to listen to the analyst call, please proceed to the Building 12. The cards are arranged outside this building. And I would also request you to limit the question to one question per publication. Over to you, Salil.
Thank you. Good afternoon. Good afternoon, everyone. And thank you for being here today. It's really an exciting day and announcement evening for us and me. It's our first full year. And from my perspective, it's been really an incredible year that we've had as a company. Obviously, you've seen the press release, but I'll give you a few of the highlights. I'm truly pleased with the sort of results that have come about and with the transformation we've driven this year. And the results demonstrate some of the first steps of that transformation. We have increased our client relevance, and that shows up in our full year growth. Full year growth is 9% constant currency, and in the quarter it's 11.7%. So an incredible year for growth and further acceleration in Q4. Our sequential growth constant currency basis is 2.1, which is yet another strong quarter for us after the first 3 quarters of the year. Our clients are seeing more and more value with our digital portfolio. This was driving our full year growth. So full year digital growth is just at 34%. And the Q4 growth for digital is 41%. So we see again that all of our investments in digital are resonating with our clients. And we can see that this is further accelerating in Q4. At the end of the year, we now have 34%, just over a third of our revenue coming from digital. To give you one example, we are really delighted that our digital banking platform has gained tremendous traction in this fiscal year. We have 7 new global logos on our digital banking platform. That's a real achievement with the way we've repositioned that platform, re-architected it, and driving the digital agenda. We've seen our clients select us for critical work across data, analytics, cloud, IoT, cybersecurity, all of the elements of our digital pentagon. On large deals, again, we had an exceptional quarter, 1.6 billion in new large deal wins. From that, a total of 6.3 billion for the full year. That's twice the value we had in fiscal 18. Again, our investment in sales are starting to help us build the momentum that we need. And we can see that in the number of large deals. And in fact, you'll hear some more stats on the net new in a short while. Our engagement with large clients is also growing well. The number of large clients over 100 million in revenue has increased to 25. It was 20 this time last year. What we see now is our planned investments in sales and in building a business model which is resilient via localization in all of our key markets. That's starting to pay dividends. It's yielding benefits. Our margin for the full year was within our guided band at 22.8%. And our margin for Q4 was at 21.5%. Going forward, we see the ability now to drive operational efficiency into our business. Overall, we see our business being more stable and better positioned to benefit from the shift to digital in the years to come ahead, and also to build business resilience into our model. All of that leads us to our guidance. Our guidance for fiscal 20 is revenue growth in the range of 7.5% to 9.5% in constant currency. and margin in the range 21% to 23%. I'll pause there and we'll open it up for questions. I also want to welcome Nilanjan, for whom it's the first interaction with you in this formal capacity. We all look forward, Praveen, Nilanjan and I, to address your questions. Go ahead, please.
Thank you, Salil. Before we open the floor for the Q&A, I would like to reiterate, please ask one question per publication. And we'll begin with the electronic media. And the first question is from CNBC.
Hi, this is Mukta from CNBC. Firstly, congrats on a great quarter and a great year. My question to you, Salil, is, why is the guidance so low at 7.5 to 9.5%, especially because you've doubled your deal wins? Why is it not reflecting the accelerated growth? To Nilanjan, I have to ask, why have you cut margin guidance by 100 basis points? And why was the Q4 margin at, 21.4%, which is much lower than expected? And to Praveen, attrition is still high. You've mentioned that in the press release as well, despite steps being taken by the company. What more are you doing? And, would this impact margins going forward?
Let me start with the guidance. I think the way we construct guidance is looking at what we've done in terms of the full year in the new wins, but also making sure we look at what's going on in the market. We have a very strong acceleration for the full year, and therefore guidance, if you recall, for fiscal 19 was 6 to 8, and we've now bumped it up to 7.5 to 9.5. So from our perspective, it's a very strong movement of the guidance in the growth direction. So we've not actually cut it in that sense, because we had a guidance this year of 6 to 8. We've delivered 9%, and this 7.5 to 9.5 fits very well within the range of guidance, within the range of growth that we anticipate for the full year.
Yeah, on the margin question, I think I'll just step back and go back a year when the new Navigate Your Next strategy was announced. And I think there were 4 key pillars which the company set forth. One was, of course, building the digital framework. And that, of course, has led to the increased growth. But this also called for additional investments, which we had to make in digital talent throughout the year. So one of the reasons of the margin impact has been the investments we have made beyond digital, getting new digital talent into the company. If I look at the second framework for the Navigating Your Next was about energizing our core, which is basically how do we get automation and AI and drive efficiencies in the operations during the year. And many of these are, of course, in our business passed on to our clients. And I think during the last year, we have seen about 90 basis points actually of margin efficiencies coming through the various levers which we have. The thirdly is, I think, in part of the strategy was localization. This is a very, very important future-proofing for the company. In the United States, we have been setting up innovation hubs. We are, I think, ahead of the peer set. We have set up 5 hubs across the US, and also hiring local talent in a global delivery model to de-risk our business in the future. And I think this is an investment which we believe is much required. And I think that puts us to build a much more robust framework and a model for the future years. And of course, the last was about reskilling our people. And I think as part of that as well, the investments we have made into refactoring our employees, I think that's also been the investments we've made. So I think as we guided the market at the beginning of the year, although we ended last year at 24.3, our margin guidance was between 22 to 24. So we had seen these investments coming, and we ended at 22.8. So I think this has been a thought-through program, and the guidance for next year actually reflects the margin of where we are from Q4 and how we build forward.
On the attrition front, attrition is definitely higher than where we anticipated. It's increased slightly from 17.8 to 18.3 at Infosys Limited level. There are multiple interventions we have started in the last quarter or so. We have come up with a new employee value proposition, which is focusing on engaging better with employees, enabling them, creating more career opportunities, and providing them a very rewarding experience. So there have been many, many interventions we have done in the last quarter. Some of this will take time to yield results, and we are also looking at wherever there are gaps in compensation, or we are trying to fix that as well. The primary, when we segment the attrition, the primary areas where we are seeing challenges are people with 3 to 5 experience here, and probably about 2 to 3 years experience in US. So that is a segment we need to address, and we are also introducing milestone-based increments. We are also now encouraging people to get certified, become digital specialists, and then we are coming up with incentive scheme for people who have what we call internally as digital tax. So there are multiple initiatives underway, both addressing any hygiene issues that we have, as well as some of the new things. And part of it is also about better narrative about the kind of opportunities we have, because kind of investments we are doing in terms of their own career progression, career enrichment, and so on. So we expect in the next couple of quarters things should become better. But this is something we constantly focus on, and we understand that this is a critical thing. And we want to bring it down to 13 to 15%. That's where our comfort is going forward.
Next question is from ET Now.
Hi, on your left. Hi, everyone. Rahul Dayama from ET Now. Salil, my question to you is, even last time we did, talk about, are there macroeconomic buzz that is really impacting growth? You said we still need some more time. Is that, could you call out some of those factors? Are you seeing some of those factors among clients, conversations, the IT budgets have shaped up, you have a lot more clarity. So is there a macroeconomic headwind, so to say? And then I'll come to the others.
So today we don't see a macro headwind across the business. There's a lot of talk as we went into planning for this fiscal year. There are some areas, for example, we see manufacturing in Europe, which is showing us some weakness. We see healthcare, which is showing us some weakness. We see life sciences, which is showing us some weakness. But these are not across the whole business. Overall, we feel there's still robustness in our business, and that's what's reflected into our guidance.
One more, Salil, before I go to Praveen. 3-year roadmap, FY19, stabilizing the business, FY20, build momentum. So is that on, or would it take another year to, because you've ended this year on a strong note, but there are some concerns as far as margin pressures are concerned as well. So would you say another year to sort of see how you would want to stabilize the business?
I think from my perspective and our perspective, the business is today in a very stable situation. And in fact, we saw some of the early acceleration or building momentum already starting to come into Q4. With respect to the margin, as Nilanjan was sharing, our main focus there has been to make sure we invest in the areas that need investment for future-proofing our business. So that is the way we look at where our margin is. We also have some levers now which can drive operational efficiency into fiscal 20. So from a business stability perspective, my feeling today is we're in a much more stable place than we were 12 months ago, 15 months ago. We also start to see in different ways. If you look at our digital growth, 41% year-on-year growth in Q4, that's actually beyond momentum and acceleration. It's quite taking a real position in that market. So we will continue that. The 3-year journey for us, the roadmap is well laid out. And in fact, some of those things we are starting to hit sooner, but we've given ourselves the journey time of 3 years to make sure that we become really fully functioning in the sense of stability, momentum, and acceleration, even if some of the elements start to show up earlier in our trajectory.
All right. Praveen, in terms of financial services, last quarter also you said you're pretty upbeat as far as the demand is concerned. So is this a one-off affair? You had indicated that FY20 will look better. Do you still stand with that statement that retail and BFSI, the concerns will ease out?
We are very comfortable with where we are with respect to financial services. This quarter, obviously, you saw a negative growth in financial services. If you look at banking alone, we had a positive growth, but on the insurance sector, we had a negative growth and it brought the overall growth down. But on the other hand, again, in insurance, if you look at it on a year-on-year basis, we have had a double-digit growth. So we feel very optimistic about it. Even in the large deals that Salil talked about, we had about 13 large deals, out of which 3 were from financial services. So we feel fairly confident on the back of all the large deal wins that we have had in the past, as well as the momentum and the pipeline that we are seeing. So we continue to believe that FY20, from a performance perspective, it will be better than what we have seen this year.
All right. Lastly, Nilanjan, in terms of margins, Salil also spoke about there are levers as far as operational efficiencies are concerned. Could you talk a little more about it? Because as far as subcontracting expenses, we have seen the peers also highlighted over the quarter. Is that a concern? Investments is something that you have been making for quite some time. So, what really are the levers that you have?
Lever, of course, we have is on pricing, and as you see from our numbers, our RPP, which is a revenue per person, has actually grown on a constant currency by 0.2%. Now, of course, underlying that is, of course, in an up kind of business, there are always pricing pressures, but you have other levers to make this up. So there's digital pricing, for instance, where you can command a premium. And I think we've also said that our digital margins are higher than our core margins. I think secondly, from an operational efficiency perspective, I think there are multiple levers which we continues to use. The use of automation in all our projects and how that can bring in efficiencies, how we use the onshore, offshore mix, how we started making now an on-site pyramid and more broad basing that. One of the advantages of the localization initiative in the US will be giving us an initiative and benefits on that. So I think we have multiple levers which we can use. Utilization, for instance, is something which we can use. We've seen a slight dip this quarter, but I think that can be ramped up. So I think there are multiple levers which we use and we will deploy as the year progresses. So I think that gives us confidence in the guidance which we've given.
Next question is from Bloomberg Quint.
Hi, this is Shivani Saxena from Bloomberg Quint. My first question to Mr. Parekh. While factoring the revenue growth, what verticals and services lines have you predicted will grow in FY20? The next question, kind of related. How are you factoring in the operating leverage and increased localization against rising wages and potential currency headwinds in your market, in your margin guidance? I'll come to my question after.
In terms of the growth, we're seeing really good traction, for example, in the way we see the telecom sector developing, the way we see the utilities sector developing. We have good traction in retail, good traction in the services business overall. So there are several segments, subsectors within our business that show us really strong traction. As Praveen shared, our financial services outlook for the full year is still quite strong, and that's a large part of our business. So those were some of the components that went in as we built the combination of our guidance for fiscal 20. The second one, what?
So the second one is on the margin guidance. How are you factoring the operating leverage and increased localization against rising wages and potential currency headwinds?
So those are exactly the factors that have gone in to build the margin. And each of those factors has a role to play. There is obviously going to be wage increase within the fiscal 20 plan, but there's also a lot of focus on how we're building localization. We want to build out a new way of looking at the workforce, and that's part of the approach we're taking there. All of the FX factor, of course, we've kept aside. This is based on where we see spot FX today, so we don't factor that into our guidance.
Sure. In terms of the free cash flow, apart from buybacks and dividends, where else do you see investments? Are you looking at, where else are you seeing a capex going forward?
The capex itself, I think there are two parts to it. I think in terms of what do we do with the cash flow, it's certainly we state our policy, which is up to 70% free cash flow, which will return to shareholders, and that's the approach we continue to use for fiscal 20 at this stage. On where we use the capex, we have a really lot of investment going into repurposing buildings capacity for agile workspaces. So we've taken, in fact, large chunks of our locations, for example, in Pune, where we are putting a completely new development focused exclusively on agile. We're doing that in many other locations by buildings or by floors or sometimes by projects. And there's an overall plan that lays out where that's going to happen. There's some of the capex, which is building out some of our infrastructure in the US as well.
Any acquisitions, key acquisitions and investments?
So no comments on acquisitions. As always, it's an active part of our review, but nothing specific to report today.
Next question is from Money Control.
Hi, Salil here. Swati from Money Control. I have a couple of questions. One is about your geography. So I can see that the India is coming down, the India share is coming down. That is one question. Could you just throw some light on that? Should I ask questions one by one or?
On India, I don't think you should read much on that. It's a very small percentage of business. There's a lot of government project concentration in that business, and these are all large projects. When projects and or projects move from a development to a maintenance phase, revenue drops off. So it's really very small percentage, and you will see this quarterly volatility. I don't think you should read much into that.
And what is your localization rate right now? You've been stepping up your
We
localization.
don't share that statistic externally. We, of course, track it internally.
Okay, and it's not just in the US, so you're also stepping up. So how much is this up? And that is one part. Which other geographies you're stepping up? Recently, Australia, you promised that you'd be hiring more people, 1,200 if I'm right. And also, how much is the subcontracting cost affecting your margin?
So on the subcon, again, we don't specify the breakup into the margin, but we certainly talk about the subcon cost itself. Um, the um, the localization in other geographies. So we are looking, for example, in Europe, and we'll have some announcements for what we want to do in the European market in the coming quarters. We've already got some thinking on what we want to do in Eastern Europe. You mentioned Australia, that's already something we've talked about in the past, so nothing new in there. On the subcons, maybe Nilanjan.
I think the subcon talks back to, I think, when we started the year and we're seeing this ramp up of the growth as the year has progressed. I think that's where we've seen a talent crunch, and that's where we have actually ramped up subcons. But over a period of time, these are taken off the rolls, and the new talent which is coming in across from the universities where we are hiring. So this is a short-term thing. I think over a period of time, we will stabilize this definitely.
And one part about utilization. So Mr. Praveen had mentioned that utilization had come down. I can see it in the results as well. So Infosys has consciously has tried to reduce bench since 2012 with the implementation of zero bench policy. Could you talk about bench utilization and what the company is doing to consciously reduce the bench?
See, zero bench initiative is ongoing initiative. The initiative is more about engaging people who are on the bench to equip themselves with newer skills or do something much more meaningful and contribute to some projects, POCs, and so on. So it's not really related to increasing the utilization. It is more related to keeping them engaged gainfully. On the utilization front, as you are aware, till about a year back, we were operating between 78 to 80% band. In the last year, we have increased it up to, even one of the highest one we had about 85% or so. In the last couple of quarters, it has come down primarily because of large influx of trainees into the thing, and over a period of time, in the coming quarters, you will see the utilization actually picking up. It's not really a cause of concern, it's a planned thing. Because at 85%, we were really hurting and we wanted to relax and build some flexibility in the system. And now that we have that flexibility, we will probably start looking at increasing it. It's not an issue.
Next question from Business Standard.
Hi, Sam. Devasis from Business Standard. I do have 2-3 questions. Salil sir, I want to understand that the whole market was actually looking towards your guidance, especially on the margin front, and you have again declined it. I want to understand that whether the business is structurally entering into a low margin phase, or is it just a temporary blip of 2-3 years due to your continuous investment in digital, as you have panned out when you take over. And secondly, I want to understand that revenue has really shown a good momentum in JV and partnership, and seems to be your kind of model which Infosys is pursuing very hard. But do this kind of model actually impacting the margin side? Is the margin real casualty on that? And I'll ask the next question to Praveen sir.
So let's start on the margin. I think there is no structural issue in the business in the margin. It's not a low margin business, it's a high margin business. Our aspiration is and always will remain to be a high margin business. As Nilanjan shared, our digital business, in fact, is at a significantly higher margin than some of our other businesses. That is a business which is now 1/3 of our company, that's growing at over 30%. So we can see now a play where over time, as it becomes bigger and bigger part of our business, that's going to help underline what the margin profile is going to look like. You're absolutely right that we do want to make investments. We want to call them out because this is a plan that we've put in place for a number of things. One was sales, which is already starting to show us some impact. One was digital, which is already starting to show us some impact. We've also talked about the whole approach to building business model resilience through localization, because this is a medium-term strategic imperative. We believe that this is the right thing to do for us as a company, because we are building Infosys for the next 10, 15, 20 years and not for the next quarter. And with that in mind, these are conscious decisions we've taken with the full support of the board, helping and supporting and driving the strategy. And this to me is a real transformation that the company is driving. To us, that transformation is critical, because the more successful we are at it, the better Infosys will build for the next 10, 15 years. In terms of the growth, I think we are starting to see the traction. The two specific joint ventures which I think we announced, which I think are critical. The one with Temasek in Southeast Asia and the one with Hitachi Panasonic in Japan. Those are, again, very strategic moves for the medium term. In the next quarter or the next year, they will have an impact. But they are not going to be, the real impact is going to come over multiple years, because these are partners which are massive players in their geographies. For them to select Infosys to work as a partner with is a huge difference for us. There is no impact from that partnership on the margin, because first, in the short term, is not a huge revenue play, but it's a very strategic move, because now, in a very interesting way, we have a partner who's a dominant player in each of those geographies. And as those geographies develop, and you know the way the markets believe they'll develop, we see a real good future for those partnerships. So we are making strategic plays to make sure that Infosys, through the investments, through the partnerships, is here for the next 10, 15 years, and not just for the next few quarters.
We get a little scared when your margin actually fell to a 21.5% range, which is below your guided range. And the argument seems little not plausible at this point of time, because you are a cash generating business. When you invest, you are actually going out and buying out those assets to build up that revenue stack. So that's a real concern, I think, for you or not.
So the way we look at the margin, the investments that we've talked about, which is sales or digital or localization, those are investments where we build out capacity, or we invest in people, or we invest in digital capabilities, and all of those come through our margin play. As Nilanjan mentioned, our RP actually has gone up, and so that gives a lot of comfort to us internally that we are driving through what we want to drive through in terms of the business with respect to how we go after deals. The real change for us is, if we don't put in place some of these investments, our view is we'll have a much different future in 5, 7, 10 years. And that's the reason why we're putting this in play now.
That's fair enough. Praveen sir, I want to understand, despite all your efforts, attrition remained, again stood up, is close to 20% now. So what actually those specific interventions are yielding at this point of time? Because Infosians should be proud of to be Infosians and should stay with you.
I already responded to this question. So we are really looking at we are analyzing where the issues are, and issues primarily are in two places. We're seeing higher attrition in, as I said earlier, with people between 3 to 5 year experience in India and maybe 2 to 4 year experience in US. And we are looking at various interventions to address it. It's not only about compensation, because that's an easy thing to fix. It's there are multiple things. It's also about engagement. It's also about better narrative. Because we are investing a lot in terms of equipping people with skills which will do them good in future in their career. So we have to do a much better job in terms of articulating it. We have to do much better job in terms of rotating people out so that they can get opportunities to deploy their skills in projects and so on. So there are multiple initiatives, all both on the enablement side in terms of enabling them, as well as reward and recognition side. So this is an ongoing thing, and it will probably take maybe a couple of quarters to fix it. We expect it to come back. And as I said earlier, we are comfortable with about 13 to 15%. It's slightly on the higher side, and it remains a focus area for us, and we'll continue to work on that.
Next question is from PTI.
Frankly, I decided not to ask any questions because surely Infosys is becoming boring. However, for asking sake, I want to ask a question. As per CARE ratings, India's top 5 tech companies saw a 49% drop in petitions being approved in fiscal year 2018 to under 22,500 from the previous year. So how many applications Infosys submitted and how many were turned down by the US Citizenship and Immigration Service? This is my first question. And secondly, how many Americans have been hired so far in the US? This local hiring means there is a drop in the company's margins. To address this, what alternative measures have you taken apart from negotiating with the Indian and Trump administrations? This is my third question.
See, on the first one, we normally don't comment or tell numbers about how much we have filed or rejection percentage or anything. Secondly, we have now in the last year or so through our localization effort built a very resilient model. So today, whether we get approval or rejections, it will probably not impact us in a big way because we have done extremely well on the localization front. About 2 years back, we had said that we will recruit about 10,000 Americans in 24 months or so, American nationals. In those 2 years, we have hired about 9,100 American workers in the last 2 years. And if you add people whom we have recruited through rebadging or some of the subsidiaries, it actually crosses the 10,000 mark that we talked about. So the localization effort has been pretty strong for us. It has been a significant differentiation for us. And our value proposition here is not only about hiring, but also about where we are hiring. We are creating new jobs. We are going to the colleges. We are going to community colleges. We are having partnership with universities. We are creating hubs. We are creating living labs. All those things actually is a very powerful value proposition for our clients, and it's resonated well. So we believe because of this localization effort that we undertook about a year back, now we have a much more resilient model which is far less dependent on visas or talent mobility. What was your third question?
The question was, how would you address this issue of dropping margins?
I don't think localization effort, I mean, apart from the initial investments around...
I would like to make a point, some companies, I believe, they have set up near-shore centers in neighboring nations like Mexico and Guatemala, for example. Any such plans you also have to address this issue of dropping margins?
No, I don't think it's, I mean, we are not seeing any, we don't anticipate any long-term impact on margin because of localization effort, because we are building a pyramid on-site. In the past, you would have only senior people working on-site in client locations and a mix of senior and junior people in offshore. But our model now is to build the pyramid on-site as well. So overall, once we have a full localization effort and full-scale localization going, we believe that it will be margin neutral.
Next question from Business Today.
Hi, good evening, Rukmini here. I had two questions. One around the repeat business, some bit of understanding because on a YOY basis, it's nearly gone down 2% or so. So, what are the kind of businesses really that are hitting this under repeat businesses? What are the kind of clients are not coming on board, or what is happening with that is one understanding. And the other one, especially to you, Salil, the chairman, of course, had said that once the company stabilizes, that's when he will be thinking of moving on. Any recent conversations has Nandan ever indicated for how long he's going to stay? Thanks.
Okay. On the first one, I can answer. Actually, we have done extremely well on the growth, and if repeat business has come down, it means that we have added a lot of net new business, which is a huge positive for us. So we don't see repeat business coming down as a negative thing, and I think it's about 95% or something. It's still at a very high level. And given that we have growth and we have a lot of, in this quarter itself, about 69% of the large deal wins were net new. And for the whole of last year, about 50% of the 6.3 billion that Salil talked about TCV, about 50% was net new. So this is in our mind a very positive thing, because these are all, we are increasing the client base, we are becoming much more relevant to a larger thing. We are not losing any clients. And in fact, we talked about the 100 million, number of 100 million clients as well, right? For the year, it has increased from 20 to 25, and this quarter itself from 23 to 25. We are not losing any client. In a larger, in a larger growth, it's always healthy to have a good mix of repeat and net new, because net new is something which will give you growth in the next 3 to 5 years.
The question about Nandan first, I don't want to speak for Nandan, but he seems extremely happy and engaged with the business. I've had no other discussions with him except about the strategic issues of the business.
Next question is from Economic Times.
Hi, sir. Joshelle from ET. I'm sorry to keep asking this. I know you've tried to answer this, but I still have a question on the margins. Last year, when the margin was dropped, it was because of the 4 pillars of investments: localization, digital, and you said that that was to build the future for Infosys. This year, it's been dropped again. At the same time, you will deploy margin, levers to improve operational efficiency. So, are investments increasing in certain areas, or were the costs not adequately factored in the last margin drop? And continuing with the margin, when is it likely to go back up? Because digital is higher margin now, 34%. So at some point, when do you see that happening?
So on the margins, when we look at how fiscal 19 has evolved, we start to make some of the investments as the year started. And as the year progressed, that velocity of investments increased. So the reality is much more a question of trajectory than a question of a long-term play. So in Q4, our margin was much lower than it was in Q1 of this year. And that's the trajectory that we now put forward into the next fiscal year. The reason we've talked about operational efficiency is to share with you that we already have some levers that can give us some positive view on how we're going to drive the margin for the future. In terms of investments increasing, we talked about sales, we talked about digital, we talked about localization, and there are several others, compensation, etc. The sales investments, we have now completed all the investments. However, we have a run rate in Q4, which will be now the run rate which goes through for fiscal 20. In terms of localization, a significant part of that has been achieved in fiscal 19. However, we will have some more in that, but not to the same level as we had in fiscal 19. There are other investments which will continue, but which will not be at all at the level of fiscal 19. So between the trajectory and this reduced intensity of investments, we now start to see that the operational levers will also start to benefit us. In terms of when will the margins go above this guided range, we are only talking about fiscal 20 here. When we're ready with fiscal 21 and so on, we'll talk about that.
Sorry, I thought I had to stop at one. So, can I ask also, the revenue per employee has fallen now 2 quarters in a row. Can you give me a sense of what's maybe driving that and when that might start to climb again?
I think overall, there are 2 elements. One, RP has been marginally dropping in the last few quarters. To some extent, it's also a reflection on the utilization dropping as well, because RP includes all the people thing. But the other important element is the RPP thing, the pricing realization, that has been mildly positive or fairly flat. So despite all the commoditization we are seeing in the run side of the business, through our efficiency and automation initiatives, we have been able to hold the pricing flat in that sense. So that is a positive thing.
Next question is from Deccan Herald.
Hi Praveen, hi Salil, hi Niranjan. So a couple of questions. I have a couple of questions here. When continuing on PTI's question of H1B visas. So despite the company not disclosing the rejection rate has been second highest globally for Infosys after Cognizant. So 26.1% of your 8,052 visa applications have been rejected in 2018, according to USCIS data. So, and this is despite the fact that in India, among the Indian IT services companies, tier 1 IT services companies, Infosys is the primary company which is focusing on the localization in US. So where is it going wrong for Infosys? It's the second highest rejection rate of H1B visas globally. And second part of the question is the hiring, because AI and ML are in demand of late, and we have seen a lot of IT companies complaining about lack of talent in the market. So can we have a hiring outlook for next 1 year at least? Because there is a dearth of talent in this thing.
See, I'm not sure I understand your question on where we are going wrong on the rejections or whatever. I think what is impacting us is impacting other services providers as well. There is enough material, enough things which talks about a high rate of rejections, and that is the reality, and that is the reality we need to deal with. The point, as I mentioned earlier, is we have actually moved away from depending on that, because through our localization effort, we have built in a lot more resiliency in the business model. So to that extent, whether it goes up or goes down, it should impact us lesser. So that's what we have achieved in the last 1 year, and we are happy about it. So I don't see it as any negative or anything. It's a hugely positive thing. And despite the localization effort, it's not that we are not hiring. In fact, whole of last year, we have hired over 40,000 people, about 20,000 people from campuses last year. This year also, we are looking at about 18 to 20,000 people. The hiring in India still continues. It is not that because of localization we have stopped hiring or anything. So hiring, and we have had a huge hiring thing going on in the last 1 year, and that effort will still continue as well this year.
Next question from Financial Express.
What was your second? See, when we hire, we look at the demand, and on the basis of the demand, we hire different skills. Obviously, on the digital skills, these are very hard. There is shortage of talent. So even if you want, you will not be able to recruit the number of talent, sheer number, because simply there are not enough talent. So our effort is on twofold. One is we are internally reskilling our people in these technologies. Second one is we are hiring, wherever possible, we are hiring talent with experience in these technologies. The third area is we are also hiring in adjacent areas and refactoring or reskilling them. So these are three levers we are using to just address the issue of shortage of talent in some of the hot technologies.
Hi, Aniruddha from the Financial Express. Sorry, my questions will be repetitive because it's already been asked. But I'll go one at a time. Firstly, on the attrition level, you mentioned some of the demographics where attrition is particularly high. Can you give us the exact reasons why this is so in those particular demographic ranges, and why not others? And also, you said that compensation is not it because it's easy to fix, but how important is compensation in the whole attrition issue?
See, I think at this demographic, when you look at it earlier, the significant value proposition for this crowd in this industry was on-site opportunities. Now with a lot of restrictions on visa and lack of mobility, so that value proposition has gone. So we have to come with a differentiated value proposition. And one of the things we are doing is as I said earlier, we are trying to change the narrative. We are trying to articulate that this is a great time to be in. Doesn't matter whether you have on-site opportunities or not. You get an opportunity to work in cutting-edge technologies. There is a lot of disruptions happening. Perhaps the pace at which disruption is happening is fundamentally different from what we have seen in the past. So it's a huge opportunity for people to work on transformation journey of their clients. So that's something we are doing, and we are also telling people that we are skilling them. Now with our Lex platform, now people have ability. We have world-class content available to people. They have ability to learn at any time at their own pace. So people are future-proofing themselves from a skill perspective. So we are investing in all this in people, and now we will also start looking at much more aggressive rotation so that people also get opportunity to work on some of these cutting-edge projects. So it's a combination of things. It's not one single lever that will address it. So we have to do multiple things. These are some things we have started off in the last 3 to 6 months, but it's an ongoing effort. So over a period of time, we should have the necessary impact, and we are confident that the attrition will come down.
One last thing on the visa denial issues. So this is something your peers are also facing. So will you be like how much will the localization initiatives go by, and will that also be tied into you reducing the number of applications for extension of visas, or applying for initial visas? And also, how do you would you be open to any nearshore strategies to combat this issue, given the shortage of talent?
See, once again, I said I don't want to comment on the exact numbers or anything. I want to once again repeat that through our localization, we have built a very resilient model, and it's not coming at the impact of less hiring in India. I gave those numbers as well. So today we have good number of talent. We have built a good engine. Obviously, we need to continue to recruit people on site to meet the demands. And nearshore, I mean, we also have nearshore centers in Mexico, in Brazil, we have nearshore centers in Canada, and so on. But that having nearshore will not address shortage of skill, because there's a shortage of talent globally. So you have to do shortage. Only way to address shortage of talent is to reskill people, and that's what we are trying to do.
Next question is from Times of India.
Hi, sir. Shilpa from the Times of India. At the beginning of last year, did commentary on banking and financial services was muted, and the overhang continued for the remaining quarters. Just wanted to understand from you, is it because of cost reductions in some of the key accounts? Is it insourcing? Have you got some sort of an indication from the top US banks that the technology spends are going to be under pressure? Also, for the fact that you see more business coming from regional banks and fund management, what are the concerns in banking and financial services?
As we said earlier, in the beginning of this year, we were a little bit more optimistic on financial services. The growth is probably much lesser than the overall company growth. On a year-on-year basis, it has grown about 6% and odd percent. But again, if you look at within FSI, insurance has had a double-digit growth. And if I look at it from this quarter perspective, while overall growth has been negative, again on the banking side, the growth has been better. In the early part of the year, we are not seeing growth in the US side of the business, and I think in quarter 3, we started growth coming back in US side of the business as well. So right now, we are seeing some pockets of slowness in some parts of business in US, primarily in the capital market side. Whereas on the retail banking and on the payment side, we are not seeing any issues. We are seeing strong growth on the European side and the rest of the world side. And in the last 1 year, a big percentage of our 6.3 billion TCV wins that we have had come from FS space. So the pipeline is strong. We have a strong momentum. We have much more diversified across geographies. We have strong presence in Australia, strong presence in US, even in strong presence in Europe. Even within US, you have strong presence both in regional as well as large banks. So we believe that, I mean, as we said earlier, we believe that in the coming year, we are much more optimistic. We believe that the coming year in FY20, the performance of FSI will be much better than what we have seen in FY19.
When it comes to large deals, the average TCV has doubled more than 750 to $1.5 billion. What is the margin difference in some of these large transformational deals? How can they actually offset large people takeover costs and on-site hiring? If you can take us through that.
I think from a margin perspective, we look at it from a portfolio thing. I mean, there are margin pressures, but to a large extent, we are able to counter through productivity, automation, and things like that. And as we said, in one part of the business, you may face pressure, but on the digital side of the business, we are getting better margin. As a portfolio, we are trying to manage that. And from a rebadging perspective as well, initially, the cost may be higher, but when we do the large deal and we rebadge, we also plan on-site offshore. We also plan redeploying this resource to other projects because we always have demands, right? We are always recruiting. I mean, this year itself we recruited close to 8,000 to 10,000 people on site. So there's always need for talent. So over a period of time, when we rebatch people, we redeploy them into other accounts where there is need, and then we will replace them with maybe either low-cost resources, or we will do a lot of work offshore. We are able to manage, and all those are built into the model when we bid for a large deal. So it's all baked into the model.
Also, can you just give us a color on the wage hikes, the variable payouts, and the promotions? And last year, you also floated $1 million special incentives to employees. Are you going to do a repeat of that this year as well?
See, on the wage hike, we are we are repeating what we did last year. For about 85% of the population, wage hike will be effective April 1st. This is up to junior to middle management level. At senior level, it will be from July and October, similar to last cycle. The average wage hike in India will be about 6%. Average wage hike outside India will be about 1 to 1.5%. There'll be a stronger bias to giving higher increases at lower level and lower increases at higher level. And again, we will differentiate significantly. High performance will have a significant higher compensation.
Thank you, Shilpa. Thank you, gentlemen. We'll have to end the Q&A as they have to move for the next session. I would request you all to join us for tea. And friends from media who would like to listen to the analyst call, I would request you to proceed to Building 12. The carts are arranged outside.